Well, again, good morning, everyone. And again, thank you very much for joining us this Wednesday morning in the middle of August. But so many things going on in your lives right now with perhaps children getting ready to go back to school or perhaps finishing your last vacation time. Maybe some of you are out there trying to get your certification done on the FFM market or working on your AHIP for the market that will open up soon. So again, we do thank you for taking the time out of your morning to hear and learn about the annuities. And we would hope that the information that will be shared with you today, you will find beneficial to give you additional confidence as you go out into that marketplace to work with your clientele and open up another portfolio of income opportunity for yourself, as well as do some very good work in protecting their financial well-being in the future. First of all, we'd like to again do a little bit of housekeeping. For that being, your phones have been muted, but occasionally something will slip through. So pay attention that if you hear some background noise and it appears to be coming from your location, that you go ahead and remute your own phone personally. In order to get any questions answered, please type them in the box you'll see on the left-hand column for questions, and we'll address those when we get to the end of the presentation. And again, this morning, really with great pleasure, my opportunity to introduce to you Jake Quagliaroli with the Phoenix Life and Annuity Company. And Jake is going to talk to us today again about the annuity business that we really feel is an opportunity for all of you to take advantage of. He is the annuity sales manager with Phoenix. And with that, I offer you, Jake, the floor. Please take on.
All right, hey Mark, thanks for the introduction, and just want to echo a lot of what you said. First off, thank everybody for the opportunity to be on the call here with you this morning, and for taking time out of your busy schedule to hopefully learn a little bit more about annuities. As Mark said, what we're going to try and do over the next 30 minutes or so is really give you an annuity 101 background, talk a little bit about the structure of annuities, how they work, so that you're more comfortable in going in there. And then we'll close it up by taking a look at the opportunity in front of us, maybe some key questions to ask, some words or phrases that as you're sitting down, maybe positioning or selling another product, that you can be listening for to understand that there's other assets there where an annuity might be the actual solution. And then as we transition to it, what we're really going to do is spend a lot of time at that high level so that when we get out to the event in North Carolina in a couple weeks, we can look at a couple products in a lot more detail and give you some sales strategies and some sales ideas, because it truly is a great opportunity right now in terms of the marketplace with the volatility and whatnot for the indexed annuity. So with that said, let's transition a little bit. And what we're going to do up front, again, is do an annuity 101, give you the basics behind the products and how they work. This is a new presentation we've put together for you all at Messer, so hopefully, again, it'll be beneficial in helping you get a higher comfort level with how these products work. As we talk about with the fixed index annuity, the strength of these products are you're getting upside potential, upside protection without any downside risk. So what we're doing is we're taking the volatility out of the equation. When you sit down with a client, whether you're positioning a health type product or a life insurance type product, there's also assets that client might have sitting in an IRA, a 401k, a Roth IRA, where they've been accumulating these assets for 10, 20, 30, 40 years throughout their working days, and now they're getting closer, or maybe they're already in that distribution phase, and they need these assets for income throughout retirement. Well, what you're getting with the fixed index annuity, again, is that upside potential, that upside protection without any downside risk. So how do they work, first and foremost, and what's the appeal of the fixed indexed annuity? It's that the index annuities, again, give you the potential to exceed traditional fixed interest rates without exposing your client's principal or past interest credits to market risk. So again, let's take a client that's been accumulating assets in again, 401k, a 403b, however those assets are allocated. More often than not, those assets have full market exposure. So that client is used to the potential of significant growth, where a money market account, a CD, a savings account, really isn't going to even keep up with inflation. Well, here what you've got with the FIA is you're able to protect those assets, give that client the potential for a significantly higher gain, again, without exposing their principal or those assets that they're counting on throughout retirement to be there for them. With this fixed index annuity, what is it? In its most basic term, an FIA is a fixed annuity. And I know that seems sort of basic there, but again, the power of that is this isn't a variable annuity. It's not a mutual fund. It has links to S&P 500 or other index strategies, but you don't need the licensure such as a Series 7, a Series 6, a securities license. All you need is your traditional life and health license to be able to sell an FIA because it is classified currently as a fixed annuity. So let's go through first off the contract mechanics of how an FIA works. Again, you're sitting down with a client and you address a need. They've got an IRA, they've got a savings account where they've got assets sitting there, and they've got a premium dollar. And you realize that an FIA, based on the benefits and the strength of these products, is the solution for that client. So you take their premium, you fill out an application, and then you're mailed a policy from the insurance company. And that policy is a promise by the life insurance company that at some later date, we'll start paying an income stream to the client. And remember, with an indexed annuity, you've got a vehicle that will guarantee a payment for as long as that client lives. The only product out there that, regardless of how long that client lives, whether it's 85 or 105, the insurance company is going to pay the income that they're expected for as long as they live, and that's all addressed in the policy. Once the policy is issued, then generally you've got the insurance company that's allocating those assets for the general account and also purchasing vehicles which give you that link to specific indexes. Now, as I mentioned, there is no principal risk or there's no risk to any gains that have already been credited to the account. And how the insurance company does that is we take a high percentage of the premium and we purchase bonds. Any remaining funds after the bonds are purchased then go and give us that link to an index, whether, again, that's the S&P 500 or another, which allows you that upside potential for interest credits. So in a traditional fixed annuity, you have your client has an interest that's credited to them based on a specified interest rate, which is going to be, again, lower than the upside potential that you've got with an FIA. With an FIA, we're going to use the interest credits in a different way, linking them to the S&P 500 or another index to, again, hopefully maximize the return that client receives. Interest is then used to purchase what we call, and I know some of this might be a little bit more detailed than you need to know, but I'm trying to show you sort of the mechanics of it, where first and foremost, again, premium is used to buy bonds to get the guarantees that you've got, which is the strength of the FIA. The remaining principal goes to purchase call options, which give you that link to that major market index. If the index rises, the client gets interest credits and their policy value or their account value increases. If the index falls, the interest credits are going to be reduced. But remember, if there's, for the given crediting period, if it's ever negative, that client's going to get a zero. So their account can never go backwards unless again, they take an excess withdrawal, which we'll talk about surrender charges in a few minutes. Last but not least, the most important feature that you need to take from this whole presentation is your client will never lose any principal or past interest credits inside of the FIA. And I know we've said it multiple times, but the strength of the FIA for a client who's trying to maintain a certain lifestyle throughout retirement is their principal, their income, the gains that they receive is never at risk inside of a fixed indexed annuity. So what are the top producers saying in terms of these products? Basically, they need to know the understandings of the mechanics of the product. And we've hammered that idea home over and over and over again, that basically we're taking volatility out of the equation. So those clients' assets are there when they need them. But to properly explain the product without confusing the client, we're going to reduce it down to 4 performance principles that really hammer home that concept. And there's marketing pieces that we've got available for you that really show this concept. But the first principle is your client is going to participate in any period with a gain. So you look, if the market goes up, the annuity account value is going to increase as well. The second principle is that you don't participate in any period with a loss. So if the market goes down, your client sits out the bad years. And remember, you can't lose any of the principal or any of the gains that have already been applied to the policy. Next contract year, the market goes up again. The account value for your client continues to go up. Market down, client then sits out. So the third principle is increases in value are locked in each period and can never go backwards based on performance of a specific index. What happens the following year? Account value will either grow, or if the market's down, obviously it will stay the same. So again, the power of the FIA is we're taking out that negative volatility, ensuring that those clients' assets at their time of need are there for their income, are there for their lifestyle that they're planning to live throughout retirement. And you'll never lose value due to movements in the market index. And I think we've said that 4 or 5 times already. And again, you'll continue to hear that theme because that's the strength. And the main thing you need to take from an Annuity 101 class is the value of the FIA and how it operates. So let's take a look at a more standard look in today with a lot of volatility or a bubble economy. What if the market goes up for a number of years and then declines? You can see with the FIA, the contract value is going to grow. And as you've seen over the previous slides, we're going to flatten out so the client does never participate in a down market. What about a case of bad timing? If the market drops for the first couple of years and then recovers, we've all probably heard that sequence of returns. And for a client that has full market exposure and they're taking income, whether that's 3, 4, 5% from their account, but the market adjusts and has a downturn of 20, 30% for the first couple of years, that's going to potentially run out their money if they have full market exposure in a much shorter period of time. Again, remember with the FIA, what we're going to do is we're going to flatten out that premium. It's never going to go down. And then you're going to see that significant increase once the market turns around and starts going up. So as we like to say, we're basically crash-proofing our clients' money by utilizing the FIA and maximizing their premium throughout their retirement days. Let's jump it forward a little bit when we talk about another strategy or another strength of the FIA, and that's tax deferral. Basically what tax deferral is it's your right to decide if ever in your lifetime you're going to pay taxes on the interest you earn. The other strength of it is a strategy that I don't have the actual terminology listed, but it's what we like to call triple compounding. And what I mean by that is your client is never going to pay taxes on their annuity until they take a withdrawal from the account. So think about it. Each and every year, if they had tax liability or tax consequences with these dollars, they'd be paying taxes on that premium. So when we say triple compounding, you're getting growth on your principal, you're getting growth on your interest, and you're also getting growth on the tax savings that you would be paying in a non-qualified type account. So that's where that triple compounding comes into play, and it can really help maximize the growth inside of this contract because of that triple compounding component and that tax deferral component that you've got inside of each and every contract, whether it's qualified or non-qualified. And this will be a great opportunity to sort of break in, and I know that might be basic terminology for some of you, but for some of you that are newer to the industry, what you've got with qualified money is your pre-tax dollars. So you're looking at your traditional IRA, your 401k plan. It's premium that the client has never paid a tax consequence on before. Non-qualified are after-tax dollars. So you've got your checking account, your savings account, money that's just sitting there where the premium's already been taxed. Inside the fixed indexed annuity, even though on a non-qualified account you've already paid taxes on the principal, you get tax deferral on the growth until your client takes a withdrawal. So again, compounding that triple compounding, maximizing the growth inside of the contract. Another strength of the FIA in terms of disclosures is once you've understood the tax deferral and once you've understood the power of never having a downside opportunity, you now know how the FI basically works. It's important to understand there's other features inside of it. You've got minimum guarantees, so you've got minimum growth components. You have surrender charges, and surrender charges aren't necessarily, I know people see them and they think that they're a bad thing, but surrender charges are really there to protect the client and protect the insurance company. As you can see, there's a lot of upside opportunity with the company in terms of the risks that we're taking, because in down years, we're protecting that client's principal. So surrender charges are really there to protect the policyholder if there were ever to be a run on the books or those types of things, to make sure that their assets are always there. And you also have yield expectations or growth expectations, and you've already heard us say the expectation is that you will outpace your traditional interest rates earning potential inside an FIA. So first and foremost, surrender charges. The best way that I found to really explain how a surrender charge works is to give you an example. And here you see we've got a client with a $100,000 annuity. With most annuities, you have a penalty-free withdrawal period. And what that's going to do is give that client access to 10% of their account value each and every contract year. So they're able to get 10% out without ever having to pay a surrender charge. Anything above that 10%, that client would be assessed an 11% surrender charge. So in this situation, let's say that client needs some liquidity and they need some assets, maybe for a medical emergency, or they need to make a down payment on a car or a roof, or help a grandchild out with college. Well, here they're able to do this inside of the annuity. 10% free withdrawal, $10,000. You can see that client has a penalty-free amount of that $10,000, so they're not going to pay a single surrender charge on that premium. Now remember, what they are doing at this point in time, because they're taking a withdrawal, there is the potential for tax consequences. Whether it's qualified or non-qualified, that's going to determine which amount of that withdrawal is going to be taxable. But let's look at the surrender charge in a little bit more detail. Let's say that client has a little larger need and they need a 20% withdrawal, or in this scenario, $20,000. You can see the penalty-free amount is 10%, so that initial $10,000 of that withdrawal is not going to experience a surrender charge. The second $10,000 will experience a surrender charge. Remember, that was 11%, or roughly $1,100 in surrender charge. Take that as a percent of the account value, and instead of 11%, it's actually just 1.1%. So to get the $20,000 out of the account, based on the account value, that client's going to pay a 1.1% overall fee, which equates to that 11% on that $10,000. You can see, we'll go through a couple of additional examples. You see if the client needed 30% withdrawal, 40% withdrawal. They do have the ability to get that in a significant emergency. But remember, the strength of the FIA is the power to take out the volatility from a market. So they're long-term vehicles which are there to provide an income throughout that client's retirement days. So they're planned to be long-term vehicles. You don't want somebody that's looking at the product saying, yeah, you know, I like to move my money around from account to account. I need to tap into this, you know, take out 50, 60% of this on an annual basis. That's not the right client. You want somebody who's got, again, assets that have been sitting in a 401k, an IRA, a savings account that's earmarked for retirement income. Put it inside the FIA and know you're providing a product that takes, again, out the volatility and provides a lifetime income stream for that client. Another idea is the yield expectations. We see, again, how the product works through a lot of different slides that we show. We take out the downside and we attach the upside. Index annuities, again, give you the potential to exceed traditional fixed interest rates without exposing principal or past interest credits to market risk. So let's look at how that looks in terms of the crediting strategies that you've got. Commonly, what you'll see is annual point-to-point, monthly point-to-point, or monthly average strategies. And you're going to hear terminology like caps and spreads or participation rates. And what you'll see with an annual point-to-point strategy, and we'll break each one of these down over the next couple slides, what that does is it addresses, or it focuses on how interest is credited in the account. With the annual point-to-point, what we're going to do is we're going to have a cap, which is the max the client can earn in any given year. So let's take a look at that strategy. Here you can see we've got the S&P 500. It's an actual example from July 1998 till July 2003. With the annual point-to-point strategy, what we're doing is we're focused on 2 points. You can see first and foremost for the start of the contract, year one, 1998, $100,000 premium, and the S&P 500 index technically grew about 18%. So from July 1998 to July 1999, those 2 points, the S&P 500 went up 18%. So a client with full market exposure, their $100,000 premium would have grown to a little over $118,000. With the fixed index annuity, remember, with the annual point-to-point strategy, we're worried again about those 2 points, July 1, 1998, July 1, 1999. But because of the strength of the FIA and the ability to provide a lifetime income and the ability to protect our clients' assets, the way the products work is there's a cap. And in this scenario, it's a 7% cap, so the maximum the client can earn in any given year is 7%. Because we exceeded that, the client gets the full 7%. Their account's now $107,000. Year 2, S&P 500 goes up again. Now that full market exposure account would be up to $130,000. We max out the 7% cap again in the FIA, and we're up to roughly $114,500. Year 3, there's a market downturn. So from July 1 of 2000 to July 1 of 2001, a client with full market exposure in the S&P 500, their account value would have gone from $130,000 down to $101,000. Remember, with the FIA, we sit out the down years. Our client's principal is protected, and their past earning interest credits are protected. So their account remains at $114,500. Year 4, we do it all over again. Market continues to take a downturn, and now full market exposure account went from $101,000 down to roughly $71,000. Again, client in the FIA, their principal and their growth is protected, so they remain at $114,000. July of 2002 to July of 2003, market goes back up. You can see we've gone from $71,000 up to roughly $76,000, $77,000 in the S&P account. Client's account, again, maxes out that 7% growth, and now they're up over $122,500 in their account value, or 60% higher than what that client would have been with full market exposure. Now think about that difference if that client were ready to retire, that additional 60% can have on their lifestyle throughout retirement. So again, it's the strength of it, it's the way the annual point-to-point works, and I will say annual point-to-point is the most commonly used strategy inside an FIA because it's the easiest to understand. Really what you're doing is you're taking whatever index that client is allocated in, and you're saying we're worried about 2 points. We're worried about the initial date, and in this example we're using July 1 of this year, and we're worried about July 1 of next year. If the S&P is higher than it was last year, you're going to get that credit up to the cap. Now if the market only went up 5% because the cap was 7, the client would get that full 5% growth to their account. The next strategy we have is the monthly cap strategy. This is going to be a little bit more aggressive of a strategy. You saw with the annual point-to-point, we're worried about 2 different points. With the monthly cap strategy, we're actually breaking down the year. And you see on the bottom axis, instead of going on an annual basis, we're going on a monthly basis. So from October to November, we have 0.71% growth in the S&P. November to December, we've got a monthly cap on this strategy of 2.8%. So the maximum the client can earn in any given month is 2.8%. If the market were up 10% for that month, they would cap at 2.8%. Then you see December to January went up 1.73. January to February, 1.22. See, then the next month we're down 1.64, 1.69. And we go through this process for the entire year because, again, with the annual reset strategy, we're not applying interest except every single year. You saw with the point-to-point strategy, we were worried about July 1, 03 and July 1, 04. Here, once we go through these 12 points and we get our credits, we add all 12 together, and we see our total return is 4.54% for that client. The strength of this index and why I say it's a little bit more aggressive is, remember, we had a cap of 2.8%. And I'm going to use 3%. Let's just say that cap was 3%. What you see a lot of people saying, well, you've got an upside opportunity if we maxed out that cap each and every month of 36%. 3% per month for 12 months is going to give you the upside potential of 36%. But the thing I want to caution, as you see in the example sort of in that middle area, the market was down 3.43% for 1 month, or excuse me, for 1 month there. There's no downside cap. So if the market were to adjust it during that 12-month period, and let's say it was down 7, 8, 9%, you can see if you've got a 2.8% cap, that's going to wipe away 3-4 months of max growth. Now again, remember at the end of the year, if we add up our 12 points and it's a negative, that client's still going to get a 0 because their principal and their past growth is never at risk. The last strategy, a little bit more commonly used, is the monthly averaging strategy. It looks a lot like the monthly cap strategy as well as the annual point-to-point. But what we're doing here is saying October of 2003, the S&P 500 was at, let's say, 1025. You see that green arrow. Then for the third of each month through the next year, we grab that S&P 500 close. We're going to add all those points together, and you see then we're going to divide by 12 and get our monthly average of 1109. We compare that 1109 to the start date, which was 10 and a quarter, and you can see we have an 8.2% growth. With the annual point-to-point strategy, if you recall, we had a cap. What you have with a monthly averaging strategy is a spread, and the spread is a fee that comes out after the credit has been applied. So you see in this scenario, our spread is 1.5%. So we had growth in the index of 8.2% for the year with a 1.5% spread, giving us a 6.7% credit to the client. So you hopefully, I know this is running through, and from a webinar presentation can sometimes be a little bit challenging. You can see the three different mainly used strategies in terms of annual point-to-point. You're worried about 2 points. July 1 of this year and July 1 of next year. With the monthly averaging, we're going to take 12 points July 1, August 1, September 1. We're going to grab those 12 points, add them together, get our average, and then compare it to our initial date. And with monthly cap, a little bit more aggressive because we're actually looking at each cell and then adding up the returns for each one of those months. So when we remember the core performance principles of the FIA, first and foremost, your client participates in any period with a gain. You don't participate in any period with a loss. Your client's account is going to increase in value, and that value is locked in each and every period and can never be impacted by market volatility. And last but not least, your client's money is going to grow tax deferred. So you see the expectation for higher yield and the strength inside of the FIA, because then you can turn this on into guaranteed lifetime income. So at the end of the day, remember the goal. Index annuities are going to give you the potential to exceed traditional fixed interest rates without exposing principal or past interest credits to market risk. And now let's quickly take the last couple minutes about who our target client is and the opportunity that we've got in front of us. When you think about how these products work, you have to start thinking about a client that's sitting down that loves to play the market is not going to be the right client for an FIA, because you see you're capped out in terms of upside potential. But somebody where volatility is becoming more risk averse, is getting closer to their retirement day, has a specific amount of money earmarked for retirement income, the FIA is going to be a great opportunity, or that individual is going to be a great prospect for these products because of how they operate. So really what we're doing is we're looking for clients with reduced risk tolerance, and they're looking for the guarantees inside of the FIA. Guarantees of principal, guarantees of growth, guarantees of income. And those are going to be the individuals that have 401ks, that have IRAs, that are perfect clients or perfect opportunities for the FIA. And when you sit down with them, or you're hearing a client talk, focus on a couple different risks out there. There's longevity risk. Clients are living longer today, and we're going to break a couple of these down over the next couple of minutes. Healthcare risks, inflation risk, investment or volatility, we've talked a lot about today. And there's lifestyle risk. And really what we're trying to do is find those clients that are in that bullet point on the right. 70% of middle-income boomers are not confident they'll have enough money to live comfortably throughout their retirement years. The great thing with the products that you currently offer, and with the opportunity to present an FIA product, a guaranteed income product, we can really address that percentage on the right-hand side of the screen and be impacting our clients' lifestyle and throughout retirement. So when we think about longevity, I won't spend a lot of time on this slide. I know we're all familiar with this, but if you came across a couple age 65, there's a real high probability that client's going to live to age 80, age 95. And you can see couple age 65, there's a 94% chance that at least one of those individuals is going to live to age 80. Almost a 40% chance that at least one of those clients are going to live to age 95. And remember, the other strength of the FIA is regardless how long that client lives, the insurance company is going to pay that income amount to that client for as long as they live. So it takes some of the risk away from the client and obviously puts it on the insurance company so they know they've got assets coming in throughout their retirement days. Last but not least, from a volatility standpoint, I know we spent a lot of time talking about the protection side of it with the FIA. What I want you to see is the impact that that can have. And what we've done is we've taken a 4-day market close on the S&P 500. Our initial S&P close was August 19th of 2015, and the markets closed at 2079.61. 4 days later, 4 market closes later, the S&P 500 was down to 1893.21, or roughly a 9% decline. So a client with $100,000 in full market exposure now has a premium of $91,033. Again, think about the impact that that could have on their lifestyle throughout retirement. But what does it mean in terms of the products that we offer and the target clients that we're working with? Well, by protecting that downside risk, you can see inside the FIA, you have the ability to offer that client a guaranteed lifetime income of $5,616 on a $100,000 premium. That same client came to you 4 days later after that 9% market downturn. That 91.33 is going to generate $5,112. So a 4-day market downturn. If you come across a client with money inside a 401k, an IRA, a mutual fund with full market exposure, a 4-day market downturn can have over a $500 annual lifetime difference on a $100,000 premium. Look at the difference with a little larger premium, $250,000. It's almost $1,500. So volatility, without a doubt, can have a huge impact. And so I like to say, one of the other things when I sit down with clients is I ask them what their definition of ROI is. And 99.9% of the time, they tell me it's return on investment. But to tie this all together and to think about who our target client is and the power of the FIA product, let's start thinking about it as reliability of income. And the great thing you've got with your relationship with Messer and Phoenix Life Insurance Company is you have the opportunity to offer the consistent leader in guaranteed lifetime income, because we're able to provide you with industry-leading income bonuses, up to 45% bonus or 14% guaranteed growth on your income-generating account. And as I mentioned, we'll spend more time breaking down these products at the event in another couple weeks down in North Carolina. But last but not least, when you think about the opportunity, and over the next couple weeks, as you sit down with clients and you think about the opportunity, and you haven't asked if they have an IRA or a 401k, look at this number in front of you. We all hear the numbers about baby boomers turning age 65. I know you guys are working with clients like that on a daily basis. And it's anticipated by the end of this year that there'll be $575 billion in the rollover market. So you've got assets in IRAs and 401ks that have the opportunity to be rolled over into an indexed annuity to provide the benefits that you've got with these products. But more importantly, how is that $575 billion allocated? And you can see roughly 80% of that $575 billion is sitting in vehicles with full market exposure. So think about the exercises that we've done today when we've talked about volatility and the impact that that can have on a client's lifestyle throughout retirement. Nearly 80% of $575 billion is a prime candidate to be talking about in FIA with a client. In addition to that, another 14% is sitting in vehicles earning next to nothing, not even keeping up with the pace of inflation. So again, impacting that client's lifestyle in retirement, especially with the longevity concern out there as well. So put it all together and you've got over 90% of $575 billion in assets is a prime opportunity to be talking about an FIA. And how many of you are asking that client if they have an IRA, if they have a 401k, if they have a Roth, and if they're happy with the performance or the volatility inside of it? Well, here you can see the numbers don't speak for themselves. You got a great opportunity to be having that conversation. And at Phoenix, as I mentioned, we'll break down each one of these products in a lot more detail in terms of sales strategies. What you have through the Messer Group is the opportunity to provide the consistent leader in the guaranteed income space with our personal income annuity, or the most consumer-friendly combo benefit FIA in the marketplace today, which is our Personal Protection Choice product, which is going to give you a great guaranteed lifetime income, as well as the ability to offer a personal care rider to address long-term care or in-home care type needs, as well as our family protection rider, which is life insurance type benefit or legacy creation without any underwriting. So with that said, I want to transition quickly and let you know that we'll talk about the personal income annuity. We'll give you some key questions and key ideas to be looking at when you talk about these products and you're looking for assets. We'll talk about the personal protection choice product in a lot more detail and show you why I believe this is the most consumer-friendly combo benefit product out there, and the strength to address a lot of different concerns with one premium dollar and no underwriting from your client's perspective. And again, we'll do that a couple weeks down in North Carolina at the event. So I want to wrap it up by thanking each and every one of you for giving me the opportunity to be on the call today. Hopefully, I know it's a lot to digest over a 40-minute period in terms of how these products work, but you've got some great resources for you in terms of talking through these products, talking through the opportunity. And with that, Mark, I guess I'll throw it back to you and see if we have any questions or before we wrap up for the day.
Well, thank you very much again, Jake, for a marvelous presentation. For you agents, again, our primary focus today was to help you get into a comfort zone as you're relaying this information to your clients. And again, I think Jake has done a great job of just helping you understand the two basic presentations of a fixed product and an index product. He's also helped you understand the strategies in that index product, keeping it simple. And if you do want to keep it just as simple as looking at the point-to-point, there's nothing wrong with that in your presentation of information. You don't have to be a guru. You certainly don't have to be a know-it-all. And probably most important, as Jake pointed out, remember, these are products that you as a licensed insurance agent can sell without any series license responsibilities. And that's a big deal. We won't get into all the things that are going on out there, but just knowing that you've got an opportunity to help your client with those funds that they have saved all this time, whether it's simply in a bank, in a CD, whether they do have their market investments. But again, as they turn those years of time and they find themselves getting closer to retirement, they are going to be more and more concerned about that potential of outliving their money. And again, that's scary. That 70% of those boomers out there are not confident that they are going to have that opportunity. So here you go again. You've got a place to come back to and bring it to their attention, and really in a very simple way. I think, first of all, I want to make sure that you all know that you certainly do need to get appointed with Phoenix Life and Annuities. You'll find them on the Messer website under our Agent Resources tool on the online contracting. So we would hope that after this webinar, if nothing else takes place immediately, at least you go back to our website and go ahead and get your contract in so that you're prepared to work with these opportunities. Also, again, I think Jake was very light with you in the end here, but just the ease of moving in to that client's financial portfolio by just asking the question after you've completed your business on their Medicare supplement or Advantage plan, or even in the health market coming up for people, where do they have their safe money? Where is that green money? And what are their concerns so that you can open that door? Also, Jake also touched on the fact that our expo is coming up here on the 11th and 12th of September, or 12th and 13th. We're less than a month away. And again, he is personally going to be there. He's going to be able to share more time with you if you have that interest, and I hope you do, to go to his table to talk with him and get some other ideas, pick up information on the products that are available. Also, that you're all aware, of course, this presentation was recorded, and I think that's very important, especially if you might have found yourself feeling a little overwhelmed, or maybe just, again, that distraction factor that takes on when you're trying to think about one thing that's said and then something new is thrown out there. So in a couple of days, you'll be able to, again, go over to the Messer website under Agent Resources to our Messer Learning Center, and Rebecca will have downloaded this recording so that in your own privacy of your home, you can go back and review it a couple of times. So let's see what we've got here on the message board. Sal was asking about the ability to view that recording. So again, Sal, just go to our Messer website. That's going to be www.messerfinancial.com, and you'll be able to do that. Also, please forward an explanation regarding loss of income on an annual basis if there's downturn in the market. Well, I think what you're trying to relate to there, Sal, is that if the market goes down, the fact is that their account is not going to go down. So if they are drawing an annual percentage base of income, they certainly shouldn't loss from the market factor. Of course, if they've withdrawn money from the account, the percentage they withdraw the next time from the balance that is on the account is certainly going to be less than it would have been the year before when it was in its full value. I think that might be what you're going on. Jake, can you think of some other angle that he might be thinking of there?
You know, could you read the question one more time, Mark? I just want to.
Please forward or explain loss of income on an annual basis if there's a downturn in the market.
Well, I guess, I don't know where angle it would be at, but I'll specify one more thing is once you turn the way these products are designed, and we talked about potential bonuses of up to 45% or 14% roll up on these products. Once you turn on the guaranteed lifetime income with these products, and let's say it was $1,000, and the market went down, first and foremost, remember, the policy doesn't go backwards. You can't lose any principal. In addition, it can impact that growth. So that client, even though the market had a negative experience, their account value is going to get a 0, but their income is going to remain at $1,000. So there's really no impact to a market downturn because of the benefits that you've got inside the FIA. And that would be my only other area on that income side of it, Mark, that I could think of. But again, we can address that in more detail offline or in a couple of weeks as well.
Yeah, and perhaps what we'll do is we'll make a note here of Sal's phone number so we can maybe get a better idea of exactly what he's trying to get to so we can address that question on a one-on-one basis. Another interesting question that just came in. Let me get back down to my question box here. From Paul, and he wanted to know that if you can borrow against an annuity the way you can withdraw and avoid a surrender charge.
Well, you don't necessarily, you can't borrow against, especially within our portfolio, and I don't know any annuities that you can. Remember, you do have the ability to take penalty-free withdrawals on the product. You don't have to repay those withdrawals. That's just taking premium out of the account. And then obviously it's sent to the policy owner. It's not repaid. There's not an interest rate to that. It's just withdrawing and taking the value of the account down.
Okay. And again, Sal, we're going to give you a call directly so we can get a better feel for and help you better understand what was in that presentation for your own benefit. If you got just a moment, Jake, could you go back and touch on that triple compounding, how that takes place so that, again, as an agent in the field, I think it has more impact when you're talking about a triple.
Agreed. So again, the strength of the annuity, and it's, again, one of the great benefits of the product, is all assets inside of this product, you don't pay any tax on it until there's a withdrawal. And that can be a qualified account or a non-qualified account. And remember, that just deals with assets, whether the premium's already paid taxes or it hasn't been paid tax, such as an IRA or 401k. And where we get the triple compounding from really allows maximum accumulation of the product is because you're not paying taxes until you take a withdrawal. You're getting growth on your principal, which is your first growth. Your second growth is you're getting growth on earnings. And then the last one, because you're not paying taxes on those earnings, you're also getting growth on those earnings. So again, if you were in a vehicle that was taxed on an annual basis, let's say you've got $1,000 in that account and it grew to $1,100, the average account paying taxes, maybe it's at $1,050. You get growth the next year, you're getting that growth on $1,050. Inside the FIA, because you've got that tax deferral and that triple compounding, you're getting growth on that full $1,100, which is again allowing you to maximize and speed up that opportunity of growing the value inside that account. Does that help? Or?
Yeah, thank you. Absolutely. Absolutely. And again, ladies and gentlemen, I know it can seem to be an awful lot, perhaps especially if you've been out of the market or not even attempting to get into the market. So again, take the time to review the presentation. Build up your questions. Again, if you're going to be with us in a month, Jake's going to be there with us. You can get back to him, and if in the meantime you need questions, answers, don't hesitate to call us. Also, you did see in the very beginning, if you want to go back, or the slide's still up there, there is the phone number for some direct access. They're certainly on the sales desk willing to take your call and assist you. Certainly we are as well, especially if you want to get an illustration run. Not a little different than a life insurance when you talk about an illustration, although there are ways to show you how the income stream can be run when you have that amount of money that you want to turn it on and let it start dripping back out to you over the period of your lifetime. I don't think I have any other questions here. So again, thank you, Jake, for bringing all this to our attention, for learning and the learning experience that we've all received. Thank each of you for joining us this morning, and hopefully looking forward to your participating again next Wednesday, as again we try to bring to your attention some additional products with our carriers that could help you enhance your family's lifestyle and income. Thanks again, Jake.
Hey, thank you, Mark. I appreciate the opportunity.
Signing off. Bye till next week, guys.